Well, good morning, good afternoon, everyone. I'm Elliot Kallen, CEO of Prosperity Financial Group, and I'd like to welcome you to a very exciting episode of Meet the Expert. Here on this show, we interview experts in the financial industry with topics, with ideas, with situations that we think would be germane and important to those listeners that we have out there. If you need to reach us, I'm at Elliot, ELLIOT, at Prosperity Financial Group. The company's website is www.prosperityfinancialgroup.com. And my office is 925-314-8503. So let me tell you what we're doing today is something a little bit different. We're interviewing an actual money manager, a portfolio manager, Duncan Farley. It's very exciting. He speaks a little bit of money speak, so we'll dissect through all these great words that he's going to come up with. And he's in a sector of the industry working for RBC BlueBay Asset Management for almost 3 decades, running distressed credit. We're going to talk about what distressed credit is and why we, as a money management firm, put that in our clients' portfolios. And if you have questions about why and how to add distressed credit or credit, which we add in general, to our portfolios, sometimes on a more conservative side, balanced, conservative, fixed income, when we do like that. What's the upside? What's the downside? Why is it sometimes better than bonds? Why is it worse than bonds? Why don't we put in high yield bonds anymore into our portfolios? And we prefer distressed credit or credit things. We're going to talk about that. And it's also part of event-driven philosophy, which means that this company, BlueBay, is going to look for situations that are in trouble, upside down. Companies flat, they're flailing in the water, so to speak, and they're going to swoop in, take advantage of it. And when a company turns around, and that's their goal to figure it out, then we're going to do great with that, and they're going to do great with that. So, Duncan, I want to welcome you to our show.
Thanks, Elliot. It's a pleasure to be with you today.
Absolutely. And so I probably messed up everything I just said about what you do. So let's start really basics. I'm not worried about who BlueBay is or RBC. And I wanted clients to understand that you're in the distressed credit world. What does that mean?
Yeah, look, I like to speak in simple terms just for my own sake. Simply put, we are buying stressed and distressed debt. So that's bonds, levered loans, bank debt, and we're buying at prices that are at a big discount. So when we talk about a stressed investment or a stressed bond, should we say, that's probably trading at a price between, say, 55 and 75 cents on the dollar that we think, for whatever reason, can recover to a higher price if we want to buy it. If we're thinking about a distressed investment, you're probably paying a price below that, as low as 5 cents in the dollar, where you feel that you're going to be able to generate a return from buying in that level through a more complex and longer term investment strategy. So simply put, that's the sort of distinction, probably a price distinction between the two commonly used phrases of distressed and stressed.
So you're looking for opportunities, and you're kind of bottom fishing in a way, looking for companies that are just not operating at 100% for whatever reason, the market, the management, whatever you consider to be something that's fixable, or you wouldn't be buying it, because if it wasn't fixable, just keep going down to zero. Is that accurate?
Yeah, look, I think we love to use the phrase that's used quite often, the good company, bad balance sheet. So actually, there might be fundamentally nothing wrong with the business whatsoever. The management might be doing a great job. The issue is that particularly at the moment where the cost of funding has increased, there's just too much debt on the business. So again, if you think about a company that's 4 times levered, so its debt is 4 times its profits, if it's having to pay over 10% for its cost of funding, its debt, then simply that's not sustainable. So there will need to be some kind of solution. Now, if we go back to that definition of stress and distress, in a stressed investment where we're expecting it to survive, we're not expecting it to actually go through some kind of insolvency or Chapter 11 process. We're expecting either for it to be able to trade out of its situation, or maybe we think the owner, the sponsor, is going to put more equity in to be able to restructure the balance sheet to survive. In a distressed investment, we know it isn't going to survive. We know it will default, and we will buy either ahead of that, providing the price is right, and I'll come back to that hopefully in a minute, or we'll buy as it goes through that insolvency process. We are very European focused over here. The fund is global, but it has we're in London. We're focused on Europe. Europe has many jurisdictions, so there's complexities around that distressed investing. But yes, to your point, you're right. It could be that the company hasn't been well run, but often it's a good company. It's just the balance sheet that's wrong.
And thank you, Duncan, for explaining that. And unlike Duncan in the US with an open-ended mutual fund or an ETF that's liquid every day, this is your product that we put into portfolios. Again, call us if you have questions on that, but put into portfolios is in an interval fund structure. That's new for most people on an understanding. Can you explain that in a way people can understand that?
Yeah, well, look, if you think it's new in the US, it's still not even arrived in Europe. So, in fact, if I say interval fund in Europe, people tend to glaze over. But look, what's the neat thing about an interval fund for portfolio managers like myself investing in the asset class we are is it's a really good way to match the liquidity requirements of investors. So, in other words, your investor into an interval fund knows that every quarter they have an opportunity to take out up to 5% of the total funds invested. So if they want to take their money out and it's less than 5% of the total call, then they will take it all out, or they'll be prorated back. That provides the manager, I myself, the ability to know that I've got money that is going to be sticky. So and what's good about that is some of the investments that we do will take longer to play out. A stressed investment, we would say, as a rule, is anywhere between 3 months and let's say 18 months to sort of work its way out. But a distressed investment might take as long as 3 years. So having this interval fund structure that matches the liquidity profile or the liquidity needs of the investor with the liquidity profile of the investments is a really good way to structure a fund for this asset class.
All right, neat idea. I hope everybody understands that. Again, we're speaking with Duncan Farley, RBC BlueBay Asset Management, and he's running a distressed credit fund that we've now put in our portfolios. And if you've got questions on that, give us a call, 925-314-8503. Let me talk about the market, because you're also what's called event-driven. And as if I'm correct, we don't, as a portfolio manager, I've shied away in the last 18 months from high yield bond funds and high yield bonds. They've had a pretty good year this year because I find the parallel between them too close with the stock market. So if the stock market goes up, high yield bonds follow proportionally. If the stock market goes down, high yield bonds can blow up on you very quickly. And most people buy high yield bonds, not understanding the difference between a corporate bond, a treasury, a convertible bond, a high yield bond. They just think it's a safer place to be. And I think it's not a safer place. Am I wrong on that? Or is a better place, a better alternative, what we're talking about here, an event-driven type of situation?
Yeah, look, I sit next to my high yield colleagues within BlueBay, and we do actually quite a bit of work with them. They're a very useful source of trades for us, but it's quite different from what we're doing. They're buying an index. Their performance is matched against an index, and you're right, that index will be quite heavily correlated to equity markets. And so therefore, that's their job to manage that risk. For us, the portfolio comprises 30 to 40 single names that are largely uncorrelated, that are all there on their own merits. And as I say, they can be high yield bonds, but they can also be levered loans. They can also be bank debt. They could also, on occasions, be forms of equity, public and private equity. So we've got a different mix of assets or investments within the fund, and that fund is very concentrated on, as I say, between 30 and 40. So 3 to 5% individual positions. All I can say is if you look at the correlation statistics on this fund and the sister fund that we've been managing for over 13 years, we have very, very low correlation with all other asset classes because we've got a targeted return on each investment that we make somewhere between 12 and 30%. We do tend to get most of our investments right, and that's why the performance on this fund has been in double digits now for the last 4 years. the key to everything that we do is downside protection. That is the absolute key here. And because we're only buying 30 or 40 names, we can make sure that we do all the necessary analysis that we need to do on those names. If you're a high yield investor, you're having to own hundreds of names. And therefore, you can't do that level of analysis, and you have to accept the sort of the market risk that you're taking.
Okay, so this is kind of exciting because, one thing every investor looks for is they look for what we call in the U.S. bellwether funds, that they're going to do well in all markets. It's kind of, and we call it, I want to go to heaven with my investments, but I don't want to die before I get there. And it's difficult because when they turn on the TV, they turn on the radio, and they see on these talking head shows, Fox Business and CNBC, even when things are bad, in the middle of a recession, they'll bring somebody on that's up 18% in the middle of a recession, and they can't understand why they're not. And they don't see what that person's investing in. They don't see if that person's been buying puts the entire time or selling calls. They don't see any of that, or they don't see that, he predicted the oil embargo, and so oil shot up and the world went to hell, so to speak. And so we get this false platitude that we're going to make money no matter what happens. And then they come to me, and I want them to make money no matter what happens. Cool. Every one of my clients is personal to me, but that's not really real. So in an up market, which we're in right now, in a little bit of we'll call it a mild bull market right now, you're offering double digit. You've been performing. I don't want to say you're offering. You've been performing with double digit, but let's say that all these prognosticators are right. In the fourth quarter of 22, we were going to have a recession. Then it was 23, we're going to have a recession. Now it's going to be 24, we're going to have a recession. And I don't know if we're going to have one. But if we do, how does this affect your fund? Is it create more opportunity, or like with high yield bonds, it crushes them?
Yeah, look, what we say to investors, we certainly don't need the world to end. We don't need a major recession to create the opportunities. Who wants one, to be honest? I mean, we've got better things to do in our lives to be waiting for that. Because I do think that when people think about distressed, they often assume that you need that financial crisis moment to create all those opportunities for us. I think what our track record on this fund demonstrates is that in all markets, up or down, there is plenty going on. I mean, today our watch list of names is over 200. And whilst it's true, in the last month in particular, the high yield market has performed well, spreads have tightened in. That's not really helping a lot of the weaker, more levered names that we're focused on. So, and compared to the when I started in looking at the European high yield market back in the late 90s, where I could probably name all the issuers for the first 4 or 5 years. Today, there are hundreds, if not thousands, of issuers of levered loans and bonds, and of course the bank debt market is a trillions of dollar market in Europe where we're focused. So even if default rates are running at sort of 2 or 3%, that is generating plenty of ideas for us. Now, if there was to be a big sell-off, then obviously we'd have a lot more to look at, and that would mean we'd be even busier than we are today. And hopefully our experience would mean that we're quick to work out which ones we want to be playing, which ones we don't want to be looking at in the first place. But we certainly, whilst we wouldn't want there to be a major recession, we recognize that that is going to probably present itself with an even better buying opportunity, albeit at some points we need to sell and crystallize the investments we've made. So, I mean, unless that recession was deep and went on for many, many years, I wouldn't really see it having any impact on fund performance. To the contrary, it would probably help in the interim. Okay,
these are good ideas for everybody, and and the more I'm talking to you, the more I'm understanding that it's much broader what you're bringing to the table rather than narrow. Because I think of not just so much event driven, but I think of fixed income. I don't think of growth, and I even don't think of moderate growth. But now when you're talking about what your performance has been, I'm thinking, well, maybe there needs to be a sprinkling in that with that. Is that a fair statement?
Yeah, well, look, I'd always advocate, as I do to investors, that they should have some of their portfolio in alternatives. If you think about it, we're investing in structures or instruments that are often as close to the assets, the underlying assets, as possible. They're secured on them. They have collateral. We're at the top of the capital structure. Remember, equity is at the bottom of the capital structure. In a lot of the things that we look at, the equity gets totally wiped out. So we're close to those assets, so we're protected on the downside. And because we're buying at, hopefully, if we do our job properly, at particularly low prices, we can make very sizable returns on what we do. So we always say to investors, this particular asset class, this particular fund we're offering gives you diversification, and it gives you that something uncorrelated to everything else that you have, and actually can perform in all markets, as evidenced by the performance of this fund over the last nearly 6 years, and as I say, the other fund that we manage that's been going for nearly 13 years now.
Great. So who is BlueBay? You work for BlueBay, RBC BlueBay. Who are you?
Yeah, so BlueBay is the fixed income asset manager of RBC, Royal Bank of Canada. So they're purchased by Royal Bank of Canada nearly 12 years ago now. And we have 500 investment professionals, predominantly in London, but we do have offices in the US as well, and some sales offices around the world. And we're managing across the board over $110 billion of assets.
Okay, significant. Thank you. I wanted to make sure that people understood that you're not just this little money manager in a corner of an office there, that you're actually managing sizable assets. And especially if you're thinking about what you're doing with event-driven, alternative, in the credit world, it's not like the equity world where you suddenly can get to $500 billion and $1 trillion. It's debt.
No. Yes, I mean, look, it's worth pointing out the special sits team that I work within, and this fund sits is a fraction of that. So we're just over 300 million today, and you raise a good point, because what we're doing does have a sort of cap on what we don't want to compromise performance. If we had 10 billion under management, we would not be able to generate in this market today the kind of returns that we're generating. So there's definitely a cap that is where we would be uncomfortable going beyond. Fortunately, today we're a long way below that cap, but there will be a point that, well, hopefully, fingers crossed, that we'll get to that level, and we would have no reservations on closing the fund and sticking with what we had, because we wouldn't want to jeopardize on the returns that we've seen to date.
Great. All right. So this is something, again, Duncan, this has been great for people to understand why we as money managers here at Prosperity Financial Group have added this to our portfolios. And you'll be sprinkled in between now and theoretically the beginning of January, because we see the opportunity there. And we're going into an election year, and there's weird displacement in the US during election year. There's the possibility of a recession coming. Doesn't look like we're going to get an interest rate hike again until maybe January, if we get another one in the US. These good things, when you talk about opportunity for you?
Well, look, I mean, in terms of interest rate, as I may have mentioned before, look, there's a lot of talk about rate cuts happening next year in Europe, maybe towards the back end of the year. That isn't really going to make a lot of difference to a corporate that's facing borrowing costs of 12-13%. Quarter pay, 25 bips move in rates, or 50 bips is not really going to change the dynamics there. So we don't really fear that. What that probably means, however, is the economy, is it in a okay state, or without maybe facing a recession, but maybe it doesn't. Who knows? I mean, look, we sit on a floor with some very clever macro people, and we listen and we take note, as we should do as the portfolio managers on the funds, to what they're saying. But it doesn't really dictate too much in terms of our underlying investments, that all have to stand up or on their own single merits. And that's the advantage of, I guess, what we do versus some of our others that have to sort of worry about market moves on a daily basis. We don't need to do that.
Yeah. One more question, Duncan, and that is, you're international, which is a little bit different than other credit funds that we do that are just in the US. So when I think of international, we think of every place outside the United States. It could be Canada, South America, Europe, could be emerging markets. It could be even China, which as a firm we've tried to stay away from because we're concerned about the future politically and militarily with China. We just think that's bad for everybody's business. Where are you in this world as far as the fund goes, since you are international?
Yeah, look, we could and can go anywhere, and certainly we have access to. We have an emerging markets team here. We do have access and have looked at China as an opportunity. We decided that we would pass, and that's certainly proved to be the right thing to do. But look, our bread and butter, our edge is definitely in Europe and the UK. The team comprises three British men, and then we've got two an Italian and a Spaniard, which gives us an edge in both those countries. But we'll look across Europe and the fringes of Europe as well, Eastern Europe and maybe the Middle East. Have we been in the US in the past on the funds? Yes, we have. Because, as I say, we have a leverage finance team based on the East Coast that we can use on occasion, but it's not really where our edge is. I normally say if I'm taking a call from a US broker on a potential opportunity in the US, I figure I'm at least the 100th person they've called. So we don't want to do that. We want to be the first person that people call to look at opportunities, and that's frankly only going to happen in Europe. We've done a lot in the Nordic regions. We've done a lot in the offshore space. I work particularly hard with the broker community in Oslo to make sure that I'm on their sort of the speed dial. And yeah, look, we with 140 years experience between us, we work our networks and contacts very well, and most of those are, as I say, in either in London or across Europe.
Well, this has been great, Duncan. I want to thank you so much for being part of this. You've been listening to Meet the Expert with Elliot Kallen. There are 60 or so episodes on the website, www.prosperityfinancialgroup.com. It's 925-314-8503. And it's Elliot, Elliot, at prosperityfinancialgroup.com. We've been talking with Duncan Farley of RBC BlueBay Asset Management about a very unique topic, and that is distressed credit and maximizing opportunity in the global market, particularly the European market, something that you don't usually have a conversation about. And we've added that to our portfolios. So come contact us and find out why we've added that and what we expect to do with that. Duncan, thank you for joining us.
Well, it's been a pleasure. Thanks for inviting me.
You're very welcome. Thank you, sir.